Most people believe their money sits safely in a bank account, protected by regulations and government oversight. That belief is comforting, and it's also dangerously incomplete. Behind every transaction, every loan, every international payment lies a web of private institutions, secretive agreements, and unelected gatekeepers that determine how trillions of dollars move around the planet daily. These networks operate so far from public view that even regulators struggle to map them. By the end of this video, you'll understand who really controls global capital and why it matters to your everyday life. Let's start with a question that sounds simple, but actually isn't. When you send money overseas, where does it actually go? Most people assume there's direct transfer, like an email zipping from one inbox to another, but that's not remotely how it works. The reality involves a chain of intermediaries so complex that even banking professionals sometimes struggle to explain it. At the heart of this chain sits something called the correspondent banking system, and understanding it is the first step to seeing how global capital really moves. Correspondent banking is essentially a network of trust relationships between financial institutions. When a bank in Japan wants to send dollars to a bank in Brazil, those two banks probably don't have a direct relationship. Instead, they rely on intermediary banks, usually massive institutions in financial centers like New York or London, that maintain accounts with both. Your money hops from one bank to another, passing through these correspondent accounts like a traveler changing trains. Each hop takes time, costs fees, and creates opportunities for things to go wrong. This system has been operating for over a century, and it remains the backbone of international finance. But here's where things get interesting. The banks that sit at the center of this correspondent network wield enormous power. They decide which institutions get access and which get cut off. Lose your correspondent banking relationship, and suddenly your country's ability to trade internationally evaporates. This isn't theoretical. Entire nations have been effectively locked out of the global financial system through the strategic withdrawal of correspondent banking services. It's a form of economic warfare that happens quietly, without missiles or sanctions making headlines. Now, money doesn't just move through banks. It also moves through something far less visible, the plumbing of financial markets. This brings us to clearing houses, which might be the most important institutions you've never heard of. A clearinghouse sits between buyers and sellers in financial transactions, guaranteeing that both sides honor their commitments. When you buy a stock, you might think you're trading directly with another investor. You're not. A clearinghouse steps in as the buyer to every seller and the seller to every buyer, ensuring that if one party defaults, the whole system doesn't collapse. The power concentrated in these institutions is staggering. The Depository Trust and Clearing Corporation, or DTCC, processes the vast majority of securities transactions in the United States. We're talking about quadrillions of dollars annually, a number so large it almost loses meaning. The DTCC and its equivalents around the world are essentially the nervous system of global capital markets. If one of them failed, the resulting chaos would make the 2008 financial crisis look like a minor inconvenience. But clearinghouses also make decisions about what can be traded and under what conditions. During the GameStop trading frenzy of early 2021, when retail investors drove the stock price to absurd heights, it was the clearinghouse demands for additional collateral that ultimately forced brokers to restrict trading. The hidden infrastructure of finance reached up and grabbed headlines, if only briefly. Most people still don't understand that the real constraint wasn't the brokers themselves, but the clearing mechanisms underneath them demanding more money to cover the risk. Moving deeper into the shadows, there's another network that matters enormously: SWIFT. This acronym stands for the Society for Worldwide Interbank Financial Telecommunication, which sounds deliberately boring, almost like someone designed the name to discourage curiosity. SWIFT doesn't actually move money. What it moves is information, specifically the messages that tell banks around the world to move money on its behalf. Think of SWIFT as the postal service of international finance. The letters it carries instruct banks to debit this account, credit that account, and keep track of who owes what to whom. Control the messaging system, and you control the money. This is why cutting a country off from SWIFT has become one of the most powerful financial weapons available. When Western nations disconnected major Russian banks from SWIFT following the invasion of Ukraine, it immediately complicated Russia's ability to receive payment for exports and pay for imports. Suddenly, moving money into or out of Russia became an elaborate workaround requiring alternative currencies, third-party intermediaries, and creative financial engineering. SWIFT exclusion doesn't make transactions impossible, but it makes them expensive, slow, and risky. What makes this particularly interesting is that SWIFT itself is technically a cooperative owned by its member banks. It's headquartered in Belgium and theoretically neutral. But the political reality is different. When major Western governments decide to weaponize SWIFT, the cooperative complies. This exposes one of the fundamental truths about global capital flows. The networks that move money are not neutral infrastructure like roads or power lines. They are instruments of power, shaped by political interests and capable of being turned against anyone who falls out of favor with the dominant financial players. There's a common thread emerging here. The hidden networks that control capital flows share certain characteristics. They operate with minimal public oversight, they're controlled by a relatively small number of institutions and individuals, and they're absolutely essential to the functioning of the modern economy. This combination makes them simultaneously indispensable and dangerous. The same infrastructure that enables trade, investment, and economic growth can be weaponized instantly. This brings us to a category of financial players that operates with even less visibility: prime brokers and custodians. These institutions don't just hold assets, they provide the leverage and financing that allows hedge funds and other large investors to make massive bets. A prime broker might lend a hedge fund billions of dollars secured against the fund's portfolio. This creates intricate webs of dependency, where the failure of one institution can cascade through the system. The collapse of Archegos Capital Management in 2021 illustrated this perfectly. Archegos was a family office, which is a private wealth management firm typically serving ultra-high net worth individuals. Through its prime brokerage relationships, Archegos had accumulated enormous concentrated positions in a handful of stocks using borrowed money. When those positions went bad, banks scrambled to unwind the trades. Credit Suisse and Nomura took billions in losses. The hidden leverage buried in prime brokerage relationships had suddenly become everyone's problem. What's remarkable is how few people outside finance understood what had happened. A single family office, operating with almost no disclosure requirements, had accumulated enough leverage to cause major losses at global banks. The networks that enabled this remain in place, still operating, still invisible to most observers. Beyond the private networks of banks and clearinghouses, there's another layer of hidden infrastructure that shapes global capital flows, the relationships between central banks themselves. These institutions don't just set interest rates and print money, they maintain secretive arrangements with each other that can inject liquidity into the system during crises or drain it when inflation threatens. The most important of these arrangements are called swap lines, and understanding them reveals just how hierarchical the global financial system really is. A swap line is essentially an agreement between two central banks to exchange currencies. During a crisis, when banks desperately need dollars but can't get them through normal channels, the Federal Reserve can activate swap lines with allied central banks. The European Central Bank, the Bank of Japan, the Bank of England, and a handful of others have permanent, unlimited swap arrangements with the Fed. This means that during a panic, these countries can access as many dollars as they need. Everyone else has to hope for temporary arrangements or simply go without. The implications of this are profound. Countries inside the swapline network have a safety net that others lack. When the 2008 financial crisis hit, the Federal Reserve extended swap lines to 14 central banks, pumping hundreds of billions of dollars into the global system. This prevented what could have been a complete seizure of international finance. But the Fed chose who received help and who didn't. Countries outside the charmed circle faced far harsher conditions. The hidden network of central bank relationships had determined winners and losers without any democratic input whatsoever. This dollar-centric system creates what economists call the exorbitant privilege of the United States. Because the dollar remains the dominant currency for international trade and finance, America can run deficits that would sink other nations. Countries around the world need dollars to conduct business, which means they're constantly buying American debt. The hidden networks of global capital don't just move money, they reinforce a hierarchy with the United States sitting comfortably at the top. But hierarchies can be challenged, and this brings us to one of the most significant shifts happening in global finance right now. China has spent the last decade building alternative networks designed to reduce dependence on Western-controlled infrastructure. The most important of these is CIPS, the Cross-Border Interbank Payment System. Launched in 2015, CIPS is essentially China's answer to SWIFT and the dollar-based correspondent banking system. It allows banks to settle transactions in yuan without touching the Western financial network at all. CIPS remains much smaller than the established systems, but it's growing, and every time Western nations weaponize financial infrastructure against a country, they inadvertently advertise the value of alternatives. Russia's exclusion from SWIFT pushed more transactions towards CIPS and other workarounds. Countries watching from the sidelines took notes. The hidden networks that control global capital are slowly fragmenting into competing blocks, and this fragmentation will define international finance for decades to come. There's another shadow network that deserves attention: the world of offshore financial centres. These jurisdictions, often tiny islands or small European principalities, specialise in helping money disappear from view. The Cayman Islands, the British Virgin Islands, Luxembourg, Singapore, and yes, certain American states like Delaware and Nevada have all carved out niches in the business of financial secrecy. Trillions of dollars flow through these places, often legally, but almost always with the goal of minimizing taxes or avoiding scrutiny. Offshore centres aren't just about tax evasion, though that's certainly part of the picture. They also serve as neutral territory, where parties from different countries can structure deals without subjecting themselves to any particular nation's laws. A Chinese company and a Brazilian company might set up a joint venture in the Caymans specifically, because neither wants to operate under the other's legal system. The offshore world provides a kind of stateless space for capital, free from the constraints that bind ordinary people. The scale of offshore finance is genuinely difficult to comprehend. Estimates suggest that somewhere between 10 and 30% of global wealth sits in offshore accounts. That's not a rounding error. It represents a parallel financial universe where different rules apply, where the connections between money and its true owners become deliberately obscured. Shell companies own shell companies own shell companies, and at the end of the chain sits someone who prefers not to be found. This opacity has consequences that extend far beyond lost tax revenue. It enables corruption, allowing kleptocrats and criminals to stash stolen wealth where investigators can't reach it. It facilitates sanctions evasion, as money routes through multiple jurisdictions to disguise its origins. And it creates systemic risks, because regulators genuinely cannot see how much leverage has accumulated in the shadows. The 2008 crisis happened partly because structured products designed to obscure risk had spread through the system in ways nobody fully understood. The offshore world continues to manufacture that kind of opacity on an industrial scale. So what does all of this mean for ordinary people who aren't hedge fund managers or central bankers? Quite a lot, actually. The hidden networks that control capital flows determine the interest rate on your mortgage, the stability of your pension, the value of your currency, and whether your job exists at all. When these networks function smoothly, prosperity flows. When they seize up, as they did in 2008, ordinary people lose homes, savings, and livelihoods, while the architects of the system receive bailouts. There's also a democratic dimension to consider. The people who run these networks, the executives at major banks, the technocrats at central banks, the lawyers who design offshore structures, they make decisions that affect billions of lives without ever facing an election. This isn't a conspiracy theory, it's simply how the system evolved. Finance became so complex that democratic oversight couldn't keep pace. The voters in any given country have essentially no say over SWIFT policy, clearinghouse rules, or central bank swap line arrangements. Yet these decisions matter more than most legislation. The hidden nature of these networks isn't accidental. Complexity serves those who benefit from the current arrangement. Every layer of opacity makes reform harder to achieve and criticism easier to dismiss as uninformed. When someone points out that the system is rigged, defenders can always respond that the critic simply doesn't understand the technical details. And to be fair, the technical details are genuinely complicated. But complexity isn't neutrality. The complexity itself is a barrier that protects incumbent power. What comes next is genuinely uncertain. The fragmentation of global finance into competing networks could reduce the dominance of any single power, but increase the risk of instability. Digital currencies and blockchain technology might eventually route around traditional infrastructure entirely, though that future remains speculative. What seems clear is that the hidden networks controlling capital flows will remain hidden. The question is whether enough people will understand them to demand accountability. The money moving invisibly around the planet shapes every economy on Earth. It flows through correspondent banks and clearinghouses, through SWIFT messages and swap lines, through offshore shells and prime brokerage accounts. These networks weren't designed for transparency or fairness. They were designed by and for the institutions that profit from them. Understanding how they work won't change them overnight, but it's the first step towards seeing the financial world as it actually is rather than how those in power would prefer you to imagine it.